I'm Michael Fox, and this is the Prospector News Podcast. And I'm joined again by returning guest Chris Temple of the National Investor. Welcome back, Chris.
Morning, Mike.
It's 2 days since the Fed, and as we always do, we give a post-Fed look at it and where it's been and where it's going. So I kind of took it as kind of a ho-hum meeting this time around.
Well, maybe that's the way it turned out, but I said ahead of this Fed meeting a couple of different things, not the least of which was that this one was arguably more important than the last few. I mean, if we go back to December, that was the time, as you and I spoke of at the time, that Fed Chairman Powell, somewhat surprisingly, pretty much shut the door on the possibility of any further rate increases and open the door to a discussion of when the Fed starts to go in the other direction, meaning cutting the federal funds rate and also meaning starting to slow down its so-called quantitative tightening program, letting its balance sheet actually decline either by attrition or by outright sales of assets. And the reason why I thought that this week's meeting was fairly important, and I still believe that, even though the Fed didn't do quite what I expected, is that they're back in a place that the Fed was in 2+ years ago when inflation was heating up. Everybody else saw it. Some parts of the market had reacted to it, and yet Powell and the rest of his cronies for many months thereafter said that no, it's all a figment of your imagination. Inflation is going to be transitory. Now, we all know in the end, inflation certainly was not transitory. It came back in a big way. Yes, it has lessened in relative terms since last spring/summer, but it's been rebounding again recently. Furthermore, on top of the particularly hotter numbers in January and February, it's now guaranteed that March's numbers are going to show a further increase on the headline numbers, at least because of the continuing rally in energy prices. All else being equal, you're still not seeing any significant decline in real estate and housing costs in the higher end of the market. In fact, it's quite the opposite. So, you know, Powell had an opportunity to be, I think, a little bit more middle of the road than he ended up being. He still wanted to placate that are pining for rate cuts to start sooner rather than later. Now, in December, their dot plot suggested 425 basis point cuts for this year. They did officially trim that to 3 for 2024, but the market already knew that. I think what the market would have taken as hawkish would have been if the Fed forecasted 2 or fewer. And almost half of the Fed voting members and board members did forecast less than 3 for the year. But the preponderance, the plurality of the votes was for 3 rate cuts this year. And that's all the markets needed to see to continue their party on mode. Now, if we do get a couple more months worth of hot inflation numbers, the Fed still left the door open a crack that they'll push rate cuts farther out. But by and large, and I think this was the reason you saw the market reaction in the immediate aftermath, this was Jerome Powell, as I see it, setting the table in the end for easing monetary policy, no matter what inflation is doing. And that's the next major point we're going to get to with Fed policy. I think he took a step in that direction.
Yeah. Now, before we go down that little rabbit hole, I went through all the notes, and if it's in there, I did not see it. But there was the special easement for bonds that they gave to the regional banks a year ago, and that was expiring as we went into this meeting. Did they extend that, or are we looking at a potential flashpoint happening in the regional banks again?
They did not extend that I saw or heard of, Mike, and I have to confess that unlike most times, I did not get to listen to the entirety of Powell's press conference because I was in transit. But looking at the notes afterward, also I did not see anything about that. And it's been known for a while that that term lending facility was going to expire. Don't forget that the Fed, through the back door and what's called its open market operations, has the ability to do all kinds of backing and filling. If there's a hot spot here or there in the banking system, it was beginning to look a few weeks back as if we were going to have a repeat of last spring's banking issues when we started to see a couple other banks start to collapse seemingly because of commercial real estate loans, but that left the press as soon as we heard about it, pretty much. So there's still, and this is one of the things the Fed has going for it that's still a double-edged sword. There's still so much liquidity out there in the markets, especially, and regardless of how the Main Street economy is not as robust as the financial markets seem to be. There's still so much liquidity out there that the Fed has been able to keep interest rates at this level for, I think closing in on a year without anything major, happening in a negative sense that those interest rates are. In fact, one of the questioners of Powell at the press conference on Wednesday afternoon was pointing out that, after all of this easing, the key financial conditions index shows as much credit flow and conditions as loose as paradoxical as that sounds, as they were when the Fed first started raising interest rates. And you've seen it in a lot of different manifestations. Corporate funding is been running at records, and that tells you something in the first place. When corporations have been borrowing record amounts of money or rolling over record amounts of debt, it what most people think is a high for long-term interest rates. The stock market is at a new high. Gold has been hitting a new high. Bitcoin fell off, but it was at a new high. Inflation is rebounding. So you've still got all this liquidity out there. And I think for the most part, correctly so, the Fed has held off to this point and probably for a while longer yet, easing policy at all because of all of these things. But I think that the question needs to be asked of Powell when all of these things are still in place. There's all kinds of activity in the markets, even if the Main Street economy is not doing as well. The stock market's at a new high. Credit spreads are as compressed as they were at the inflection point in 2007, before all of the problems of that age came home to roost in 2008. Inflation is rebounding again to stop declining, and it's not flatlining, it's accelerating again by more measures than not. So with all of these things, why are you going to cut interest rates? Why are you talking about winding down your quantitative tightening program? I mean, you and I know what the answer is. The answer is that to keep this whole skyscraper of cards afloat, they have to start easing again at some point, or at least stop tightening, even with asset prices high, in order to have the asset prices go higher. Because now you need a lot more financial engineering in the system to be able to service all the increased amount of debt at higher rates that we've taken on in the last few years. So they don't want to come out and say this, but as I said a few minutes ago, I think that the pivotal point for Fed policy that they are showing signs of, including this week, is that they will get to the point where they're not only done tightening, but they take steps to start easing in one or more ways, even with inflation accelerating and even with asset prices doing well.
Let's talk about this bifurcated economy that you and I have discussed on several cases. Let's leave Wall Street behind, and let's put our boots down on Main Street now. There's warning signs everywhere that if we're not already in recession, it's coming really quickly. I've seen stats now that say that diesel fuel demand is depressed. I've seen stats saying that corrugated paper, which is basically cardboard for making boxes, also depressed. I've seen stats that saying when you factor out the higher inflation rates that consumer spending is down. We see delinquencies in credit cards, delinquencies in auto loans. The average person is suffering right now and they're cutting back. And, we're going to see Powell have to make a Sophie's choice: inflation versus recession. Are we not soon?
Well, look, I've said for a long time that we've already entered the great stagflation, and we're going to have measures of both. We're going to have measures of chronically higher inflation, higher than we were used to for the last generation by and large, and that's here to stay. That is not going to go away. The only way we get to 2% sustained inflation, and sustained, you even have to put in quotes here, is if the Fed and the other central banks lose control of things, and we do have a major credit event or bust, which would cause deflation for a while. That'll bring prices down. Otherwise, the reason there are many reasons, and we really need to, at some point, Mike, you and I do a whole discussion just on this, to list off and articulate all of the various things that have changed in just the last 2 to 4 years that have totally upended the regimen of disinflation that we had, especially in the US, and I think Canada and the other Western nations to some extent as well, for 40 years. We had stagflation that peaked in the 70s. We had an era roughly of disinflation and trending, downward trending interest rates from the early 80s through, 2015, 2020 timeframe. And now we've entered into a new regime that's more like the one in the 70s. There are differences, but the pattern's the same. We're going to have chronically higher long-term borrowing costs. We're going to have chronically higher inflation. There's lots and lots of reasons for that. So this is what, the Fed is trying to balance. The part of it that you brought up, where there will be some deflation of prices. I mean, and I had not seen recently that statistic you pointed out about corrugated paper, but it's a great marker. Just like when you look at when UPS has told us in the recent past about how shipments are down and so forth. And this is when consumers have gone away to a great extent from the big box stores or any department stores, and they buy everything on Amazon. If you've got less shipments, less use for cardboard and whatnot, then yeah, consumer spending is down. And there's evidence of that across the board. As you pointed out, credit card delinquencies. I saw a chart from the Fed the other day. Credit card delinquency rates have doubled from their bottom a little over 2 years ago. The subprime auto loans, the delinquencies there, it's at all-time highs for those kind of loans. Not that they've been around forever. So yeah, you've got kind of the tale of two cities, is the famous play and book and movie habit. You've got the haves and the have-nots. Regrettably, in the system in which we live, the welfare of the haves, which doesn't reflect really the majority of society, I think, that skews the numbers for growth, for the perceived health of the economy and so forth. And so when you've got the stock market hitting new highs, and you've got corporate earnings falling off, I have to confess, less badly than I would have expected them to so far, though there is some of that. Then that's what the Fed and the chattering heads are all talking about, and it's less about the fact that I think a majority of America is feeling the pinch. They are tightening their belts. They are, they are feeling recession.
I think they are. And we first started talking about this last summer. And at that time, we were talking about, half the economy was feeling it and the other half wasn't. I would suggest it's two-thirds of the economy now that's starting to feel the pinch, and one-third that isn't. And like I see it when we go out, there's less people in the restaurants, not that I'm going out to restaurants other than I travel because, that's part of what I have to do. I have to travel. So I'm in restaurants because of that, but the restaurants aren't as busy as they were, a year ago even. So, I'm hearing, you know, Big Macs are $8.50. Not that I'm a fast food person, because, last time I probably bought a Big Mac, it was like $2. So, it's, that's either showing a lot of inflation in the Big Mac price or how long it's been since I actually ate a Big Mac. I'm not sure which it is, but where it used to be a family of four could go to McDonald's and for a reasonable amount of time feed the family, that's not the case anymore.
No,
Um,
no, and like, as you know, I live in an area in St. Augustine, Florida, that's very tourist driven. And I've even seen around our area in the recent past, if it's not the peak travel time slash season, that a lot of restaurants are suffering. I've seen a few close recently that were marginal, and we're still going to do better in our area than most places because you've got such a support for our particular area. But I agree with you. I don't care where it is. A couple, if you're going to go out for just a skimpy meal and you don't have much, if any, alcohol, you're still going to spend $40, $50 US for lunch. You add a couple of drinks a person, you kill $100 bill when a couple goes out. And that's average. It's just, and that's been one of the biggest parts, the drivers of food inflation is eating out, and they've even got a separate category in a CPI for that, and it's nuts. And so, yeah, at some point, the old saying is high prices cure high prices, low prices cure low prices, as we've heard in many different contexts. And I think you're going to see some more places close, especially in areas that don't have a healthy local economy or much tourism and vacationer support. It's going to be slow, but this is an inexorable thing. Even with all the liquidity that was generated in recent past, if consumers don't have that, they're just going to start tightening their belts. They have to.
well, even take just the basics. I'm not a big breakfast person, but every once in a while I do enjoy going out for a breakfast. And pre-pandemic, a basic bacon and eggs breakfast out, at the local diner was like $6, $7 with coffee, maybe $8. I'm looking at the breakfast menus and I'm in for over $20 for a basic breakfast like that. I'm not talking like eggs Benny and salmon lox and steak and eggs or anything like that. I'm talking just your basic bacon and egg breakfast. You know, it's astounding how much inflation has driven that. And as I say that, that's just basic meat, pardon the pun, but meat and potatoes where the ground hits the road.
Right.
So, and, I know on our own local grocery bill, it's the same way. And as we've been talking, we talk about the recession, um, but I know it's coming, but the indicators that we normally look at, energy prices and copper, they're trading high for for an economy that's poised to go into recession. So that's got me worried that if we do go into recession, that the inflation genie isn't going to be tamed by the time we get there. And again, we're back to that Sophie's choice that the Fed's going to have to make.
Well, and I think, again, not that we need to belabor this too much more, but we're going to have both. I mean, there is a whole set of reasons why commodity prices in most cases are going to continue to be chronically high no matter the health of the economy, unless, of course, as I alluded to earlier, you have just a blowout and a massive global recession or something like that. Then supply and demand things won't matter, and you will see all of these different things come down, at least for a spell. But by and large, going forward, one of the drivers of inflation in so many goods and materials is because of shortages and supply issues. These are all bad policy choices on the part of governments for a long time now. We don't have a game plan nationally for all of our energy needs going into the future. We have tinkering here, we have tinkering there. nuclear energy, as we've discussed otherwise in the past, is one of the few bright spots where Washington gets it, but in most other respects, it doesn't. So we've seen in the US at least, the whole EV rollout has taken somewhat of a hit. There will still be more EVs produced and sold in 2024 than there was in 2023, but it's not going to begin to approach what the goals had been just a couple or 3 years previously. And it's because of the high cost of all of these things. So, you'll see as the Main Street recession takes greater hold, you'll see less inflation for some items. If you want to buy toys of various kinds, boats, RVs, ATVs, whatever. Yeah, you're going to see actually, you're going to see ones that some people bought a few years ago on their front lawn with a for sale sign on them. If you want to see deflation in consumer prices, clothing, consumer non-durables of other kinds and whatnot. But regrettably, for all the stuff that we need, food, as we've discussed, heating, healthcare, auto insurance, homeowners insurance, there's no reason that any of these things are going to do anything but continue to rise.
No, and sadly, that's going to put more pressure on Main Street as we go forward. So,
Right.
looking ahead to the next Fed meeting, unless I'm missing something, I'm seeing a couple of CPIs and PPIs that are going to come in hot again, and they're gonna hold rates for another meeting.
That's likely. I mean, if we do have, and I do believe it is two sets of inflation numbers. Well, one for sure that we'll get on the March numbers. I don't remember on their calendar if we'll have all of the April information on inflation out before the next FOMC meeting in May or not. But there will certainly be anecdotal evidence of these things out there. And yeah, I mean, Powell's backed himself into a corner. He wants to placate the markets. He wants the markets to stay healthy because he needs the markets to stay healthy. And at what point does the Fed decide that, okay, well, we don't want to, fall into the transitory trap again and then invite a bigger problem? We're going to have to start taking the signals away of rate cuts and even put the possibility back on the table that we're going to tighten further, or maybe we won't reduce quantitative tightening as soon if all of these things start going up. And there are signs that they're going to. This couple of month blip in the broad range of consumer and producer price increases, which added to some rebound we were already seeing. If people remember at the end of 2023, nobody on their bingo card, if they're a money manager, an economist, or one of the people in the financial press that follows the Fed and everything like that, well, you don't want to say absolutes, virtually no one on their bingo card has a sustained rally in inflation on there and all of what that will bring with it. And I think that the odds are much greater than not that when we do get to that next Fed meeting, that has become far more evident to everybody else. And now the Fed is in a predicament. What do? We backed ourselves into a corner. Powell had to open his mouth prematurely, way back in December and change his messaging. And now his own self-professed worst fear may be coming true. What if we do relent early, even with just our words, as they've done, and inflation rebounds? We don't want to repeat, and he said this 100 times, maybe more than that. I don't want to repeat what Arthur Burns did in the 1970s. And you start tightening monetary policy to sop up inflation. Inflation starts to behave itself better. So you say, oh, goody. And you start to reverse policy because of the political pressure on you. And then inflation really takes off with a greater vengeance. And you've got to raise rates cumulatively in the end, arguably more than you would have had to have done had you stayed with it in the first place. He's on the edge of that.
Yeah.
And that is going to raise the question, does the Fed go in the other direction? Does Powell and the rest of his crew try and recover that message and annoy the markets for a while? And this is the added dynamic, of course, in an election year, raise rates anew or suggest that you might do that, which will, and you can anticipate the shrieks from the establishment and Biden supporters that the Fed is undermining Biden. They really don't want to do that, but do they do that? Or do they get to where they're going anyway? And this is the takeaway, folks. Do they get to where they're going anyway because of simple mathematics? And that is throw up their hands, and whether they won't probably bring out the actual word transitory again, but they'll come up with some mumbo jumbo and some word salad that says that no, we're not going to raise interest rates anymore. We're going to let nature take its course. But because of, and now is when they'll use Joe Sixpack and Sally Soccer Mom as an excuse. There's too much weakness in the underlying economy, credit card delinquencies, blah, blah, blah. So yeah, we are going to ease now. I hope that made sense. But those are
That
the two choices that the Fed has in front of it. They really had those two choices in front of them now. They didn't think the inflation part of it was acute enough to where they had to spend a lot of time on it. And that is, Mike, an answer, rambling, long answer to your question. That is what will change between now and May. That now it's going to be, uh-oh, the most of the news again is inflation is still rebounding. Uh-oh, what do we do?
as scary as this may sound, Chris, that answer made perfect sense to me. You and I have been hanging out alone a lot again lately, and we're speaking each other's language. So,
Yeah.
um, yeah, I see inflation coming back. As you're aware, where I live, gas prices are regulated by a central regulator. But this week they took a 7 cent jump again per liter. On April 1st, they're going to jump again when the federal government increases the carbon taxes on it. And as you know, energy fills through the whole economy. And the question out of the long rambling answer that you gave me is first off, can the Fed raise interest rates any further without, impacting federal spending? Because that's got to be a concern. And if they can, at what point does the new inflation rate have to get before they're going to feel obligated to do so?
Well, it's definitely a concern. And again, I think that if he had it to do over again, Powell would have held his thoughts close to his vest longer than he did, because now, it's like when you have, you're traveling on a family vacation, you've got a car full of kids that every 30 seconds, are we there yet? Are we there yet? Are we there yet? And you don't want to say, we'll be there in 5 minutes, and then 5 minutes goes by, and 10 minutes goes by, and 30 minutes goes by, and you're still not there. Now you got a bigger cacophony of noise in the car. Let alone if you say, I changed my mind and we're going back home. Now you got a riot in your car. And that's the position he's put himself in, because now he's got every market trader and speculator and their dog and the fleas on the dog, all 100+% convinced that the next move is an easing, and it's going to happen by the middle of the year or so. And that's what he's implicitly promised. Okay, even if he wants to, torture us with these word salads, and that's been uncharacteristic of him for a while. I mean, it used to be Alan Greenspan that would make your eyes cross when he would explain decisions. I mean, Powell, in relative terms, has been a little bit more forthright, but he was a babbling idiot a few times this last week, trying to figure out how to talk his way through the biggest contradictions he's had really to deal with since inflation started taking off 2+ years or so ago. And he was trying to explain it away back then. And now, even more so, I think he's got everybody expecting one set of actions. And if he changes that, there's going to be rebellion in the markets. There's going to be political upheaval if he does that before election day, which, again, he's put himself in this place and keeping his fingers crossed, as are people still chasing the stock market higher and whatnot. Everybody with their fingers crossed that inflation really does magically turn right back around and start falling again. And what if it doesn't? That's the bet that he's made, and the odds are he's going to lose that bet.
Sounds to me like you're projecting that he's going to turn into channeling my father and say, "Don't make me turn this car around."
Well, I don't know. It's going to be a terrible cost politically and otherwise if he does. You can rest assured that both major presidential campaigns among the establishment parties here in the US have got their talking points about what happens in any scenario. Biden and the Democrats are already all over Powell to the extent that they'll admit that there's any hardship in the economy. It's all his fault for keeping interest rates high, and they'll double down on that if he backs away from these implicit promises of rate cuts starting before election day. And on the other side, the orange wonder who appointed him in the first place and was browbeating him when he was president for not keeping interest rates at zero until kingdom come. Now he's out there criticizing him as well, which now he can do as an outsider, so to speak. So it's, depending on how Powell navigates this successfully or more likely doesn't in the few months just ahead, it's going to make an already entertaining, to use a nice word, political season that we're getting deeper into that much more entertaining.
Yes, but this is my podcast, so you can actually call it a shit show.
It's going to be that and more.
Yeah, most definitely. If people want to follow your musings, how would they do so, Chris?
Simply go to nationalinvestor.com. If you're not on my email list, sign up for it. And also follow me on Twitter at natinvestor is my handle on Twitter. That's where I probably get the biggest volume and freshest volume of stuff out.
Perfect. Thank you for joining me, and look forward to having you back on again soon.
It's always fun. We hopefully have got some people thinking again today, but the stock market rally continues, the gold rally continues, the cryptocurrencies rally, even though it was pretty volatile this last week, has more or less continued. And nobody believes that Powell and the rest of his crew will dare to even change their message much at this point, let alone turn tail. So we'll see.
Yeah, we will. Thanks again, Chris.
Take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.